The first thing we're going to talk about, Rick, is 1031 like-kind exchanges. And there is a massive tax benefit associated with that. Would you like to kind of kick that off a little bit?
Yeah, no, I love the 1031 exchange rules. I utilize them with my clients as much as possible. This is really for your real estate professionals or your guys that just want to get into that rental property, maximizing that income without paying taxes, deductions. And there's a lot of benefits to it, but there's a lot of misinformation out there about the 1031 and how it works. And I will say, we're going to go through some stuff, but I will say the biggest issue I see with this is people think I'll do the 1031 exchange and I'll do it by myself. And then I'll tell my preparer afterwards that I did this. And I have to tell them the bad news that you just foiled your own plans and now you're going to owe all these taxes because you didn't get with me or even another professional before you did it. So let's go through some of the big things here. The first one is identification, right? So you either have to have a property identified before you do the sale or within 45 days, you have to have at least identified this is the property I want. Now, what does that mean? That means you have to have gone and looked at it. You have to show that you've had a showing on it. Maybe you've got a temporary contract out there where you've put a deposit down and you want to do a little bit more inspection before you close on it. But there's got to be something where you've said, I think this is the property I'm going to use to replace my old property.
Yeah, and in some instances, you can have more than one qualified property that you've identified. Okay, you don't actually have to make that decision on which one you're closing until 180 days.
Right.
But where it's going to hang you guys is if you have not actually showed good faith and have identified that property within 45 days.